Before we begin, we should go over some of the important aspects of short selling. Most of you are probably already familiar with the concept of short selling. It involves borrowing shares from your broker, selling them in the open market, and then waiting for the value of those shares to decline. Then you buy back or cover your position at a lower price and return the shares that you borrowed to your broker. Your profit is the difference in the price you bought them at and the price you sold them at. But unlike buying shares, short selling involves an additional fee called the cost to borrow. This is the price your broker charges you for the opportunity to borrow the shares and sell them on the open market. The more in demand the shares are by short sellers, generally the higher the cost to borrow is. Typically it's less than 1% per year, but it can go higher than 20% for shares that are hard to borrow or are in high demand. When you're short selling for only a few days or even just a couple of weeks, this cost is marginal. But when you're holding a short position that goes on for several months, this cost to borrow can begin to eat into your profits. So I think it's a good idea to double check with your broker and see what they're charging you to borrow shares before you initiate any long-term short positions. I use Interactive Brokers, and they have a column you can add to Trader Workstation called Shortable that shows you if your shares are available to short and what the cost to borrow is. To keep things simple, we'll just be looking at the fee rate to get an idea of the cost to borrow. You can see the VXX costs 2.8%, whereas the VIXI costs 5.5% to borrow, even though they're very similar volatility ETFs. You can see that very heavily traded securities such as the S&P 500 ETF, SPY, and Apple have near zero cost to borrow rates. A more heavily shorted stock like Tesla has a rather high cost to borrow, up around 7.5%. If shares are in very high demand, the security may become unavailable to borrow entirely, making it not possible to short sell them. But for the volatility ETFs we'll be focused on, this doesn't happen very often. And if it does happen, in my experience, they usually become available to short again in less than an hour. So if we want to initiate a short position in a volatility ETF, we want to short the security with the lowest cost to borrow to keep our costs low. We don't know if our short position will last for a week or a month or a year, so we would want to avoid putting on a short position if the cost to borrow is just too high. This is unlikely to ever happen, but it's good to keep in mind for all short selling strategies, and definitely something you'll want to check before initiating any new short position.